尊敬的布莱恩·博斯克先生，各位来宾、女士们、先生们，大家好！欢迎各位参加今天的研讨会，感谢大家对中国债券市场的关注和支持，也感谢我们的合作伙伴国际资本市场协会在推动境外机构了解和参与中国债券市场方面所做的大量努力。积极稳妥推动金融业开放是践行开放发展理念、推动形成全面开放新格局的重要举措。近年来，中国金融业开放政策不断出台，成果相继落地。银行、证券、基金、期货等机构的外资持股比例限制已取消，中国债券和股票逐步纳入国际主流指数，沪港通、债券通等金融基础设施互联互通相继落地，南向通也于今天正式上线。截至今年6月末，境外投资者持有境内人民币金融资产超过10万亿元，其中今年上半年仅增持1.27万亿元。NAFMII作为中国机构投资者市场的治理组织，在人民银行指导下，一方面积极推动债券市场开放，NAFMII支持47家境外机构发行了超过3200亿元熊猫债，制定了与国际接轨的熊猫债制度规则，引入外资银行开展债务融资工具承销，推动国际评级机构在银行债券市场展翼。另一方面，不断完善债券市场治理管理，推动碳综合债、SLB 等创新绿色产品，推动境内绿色债券标准与国际接轨，维护二级市场秩序，完善违约处置制度，加强投资人保护。总体上，境外机构参与中国金融市场发展的渠道愈发通畅，环境愈发友好。金融市场的开放进一步促进了中国金融市场的深度、广度和制度完善。一是境外机构作为中国金融体系的源头活水，可以带来多元化的投融资偏好，有助于活跃金融创新，提升市场流动性水平，丰富国内资产配置标的。二是境外机构进入中国金融市场，可以促进高水平竞争，并促进中国金融制度的完善。境外机构会带来鲶鱼效应，推动中国的金融机构不断提升专业能力、服务质量和合规意识，加强声誉约束。此外，境外机构还可以将国际最佳实践带入国内，提高市场运行效率。金融开放过程中，境外机构必然对中国金融体系提出更高要求，例如信息披露的透明度、发行定价的市场化、信用评级的公信力、基础设施的互联互通、法治建设的完备性等，这给中国金融体系的深化改革带来了契机。实际上，高水平的金融开放必然带来金融深化改革，伴随着对金融业基于路径依赖所形成的既有市场格局、制度规则的调整。三是高水平的金融开放还有助于服务经济的高质量发展和高水平开放，吸引更多国际 ESG 投资人、GSSF 发行人参与中国金融市场，引入可持续投融资理念，支持经济向绿色、社会责任等可持续发展方向的转型。当前，在主要发达经济体仍在推行量化宽松政策、零利率甚至负利率政策的同时，中国作为全球第2大经济体，坚持走高质量发展道路，经济持续稳定增长，绿色转型加快推进，坚持实施正常的货币政策，中国的稳定高质量发展 可以让国际投资机构更好地分享中国发展的成果。最近，国务院金融委提出继续扩大高水平的金融开放，人民银行等6部委联合发文，明确提出要推动债券市场高水平开放。同时，中国正式提出加入 CPTPP， 债券通、南向通也已正式上线。推动高水平的金融开放，我们将进一步完善相关制度，实现更高水平的金融开放。特别是要加强配套制度保障，给境外机构参与中国金融市场提供便利。要丰富金融风险对冲工具，加强会计审计准则与国际趋同，提高目的资金使用的灵活性，提供更加友好的外汇管理制度以及税收制度等。总之，NAFMII将顺应市场开放的需求，认真做好各项市场服务。谢谢。
Thank you very much, Dr. Xu. It's a very good summary of the development of China's interbank bond market, and we won't touch on the sustainable finance, although this is close to ICMA's heart. We will continue to work with NAFMII closely to contribute to the opening up of the Chinese onshore market. So next will be our CEO, Brian Pisco, to give welcome remark. So Brian, I hand over to you. Thank you.
Rico, thank you very much. And good afternoon and good morning, ladies and gentlemen. I'm very pleased to welcome you to this virtual event and deliver the opening remarks together with Mr. Zhu Zhang. By way of introduction, ICMA is the International Trade Association for the Debt Capital Markets, with over 600 members in more than 60 jurisdictions around the globe. Our membership covers all types of market participants active in the global debt capital markets, including issuers, investors, intermediaries, market infrastructure providers, central banks, and law firms. Having been in the industry for over 50 years, it is embedded in ICMA's mission to ensure the well-functioning of cross-border bond markets and promote resilience and global coherence. In pursuit of this mission, ICMA focuses on a comprehensive range of market practice and regulatory issues which impact the international capital markets across the primary, secondary, repo and collateral, and the sustainable bond markets. Given our historical background and expertise in the cross-border markets, the internationalization of the China market lies very close to the heart of ICMA, especially given its size, scale, and importance. In this aspect, NAFMII has been our important and strategic partner. Since 2015, ICMA and NAFMII have cooperated closely to examine selected important topics, organized joint working groups, and released reports to facilitate market knowledge and exchange. Our reports have helped to compare the Chinese domestic practices with international ones, share knowledge about international best practices with the Chinese audience, and raise international awareness about the Chinese markets. Those joint reports on primary market practices, bond trustee arrangements, green bonds, and Panda Bonds have become very widely used. Besides these collaborative efforts, ICMA has also published our own research reports. For example, the one on the internationalization of the China corporate bond market, which was released in January this year. The Chinese bond market, with an outstanding of $18 trillion US, is now the second largest bond market in the world. It is well acknowledged that China's regulators have made sustained efforts in recent years to facilitate the internationalization of its bond market, not only opening it up to foreign issuers who wish to raise funds in renminbi onshore in China, but also to international investors so that they can invest in the domestic bond markets. We've organized today's event to discuss these two aspects. First, we will look at the Panda Bond market from the perspective of international issuers. Panda Bonds, which are renminbi-denominated bonds issued by foreign entities, were brought to the market as early as 2005. Over the years, much progress has been made, including opening this market up for foreign issuers to participate, the introduction of NAFMII's tiered management system for overseas non-financial enterprises to issue Panda Bonds, and the publication of NAFMII's Panda Bond guidelines for foreign SSA issuers, among others. This is actually a market where I have a keen personal interest, having been closely involved in the first corporate Panda Bond issuances for Daimler and Hsbc in 2014. The speakers of the first panel will discuss how the Panda bond market has performed since its inception, along with the latest trends and outlook for this market. For the second part of the event, we will discuss the Chinese bond markets from the perspective of foreign investors. This is clearly a topic of interest to many market participants. The Chinese bond markets, both onshore and offshore, have grown enormously over the last 2 decades. And we at ICMA have been honored to work closely with NAFMII and other partners onshore to encourage adoption of international best practices in terms of transparency, disclosure, credit assessment, and other aspects of the market. We at ICMA note the increasing level of interest in this market and feel the need to facilitate international investors to understand the dynamics of this vast market and subsequently learn about the 3 access channels. Currently, the 3 channels which international investors can make use of are Bond Connect, CIBM Direct, and the Qualified Foreign Investor Regime. Therefore, this year we have identified this as a topic of research and organized a working group with NAFMII for a new joint publication. Today, we are pleased to launch this market guide, Investing in China's Interbank Bond Market, a handbook. Thanks to top quality inputs from ICMA and NAFMII members in the working group, I truly believe this handbook will become a go-to guide for international investors and promote cross-border investments. Here, I would like to take this chance to thank NAFMII and the working group members, as well as my colleagues at ICMA, for their valuable contribution and excellent work across the board. I see today's event as an opportunity to discuss the internationalization efforts and progress of the Chinese bond market. Here we have NAFMII and the leading market practitioners representing issuers, underwriters, and other important players like law firms and credit rating agencies. Let me now give them the stage so we can hear their insight.
Thanks very much, Brian. Indeed, we'll look forward to the discussion after that. So before the panel discussion, let me introduce Qingren, the head of International Department at NAFMII, to give a presentation about the Chinese onshore market. Qingren, the floor is yours.
Good afternoon, everyone. Welcome to this event. It's my pleasure taking this opportunity to share with you some views on the development of China's bond market, especially on its opening up. It will be conducted in 3 parts. In the first part, I will give you a very brief introduction of the significant progress this market has made, which laid a stable foundation for further development and opening up. In the second part, the bond market opening up is a win-win situation. Besides supporting the market's improvement, it also provides plenty of opportunities for overseas participants. The third part is about the market development prospect. I would like to share with you some further steps towards a high quality development and opening up. Over the last 10 years, China's bond market has experienced significant growth. By the end of this June, the outstanding volume has reached 124 trillion RMB, becoming the 2nd largest all over the world. During its growth, the bond market plays a more active role in supporting China's real economy. 10 years ago, the outstanding volume of over GDP ratio was less than 60%, but now it grows into 110%. At the end of last year, the ratio of the outstanding volume of bonds to loans has increased from 36% at the end of 2007 to 63% at the end of last year. In terms of the aggregate social financing, an indicator reflects supporting degree of finance to the real economy. At the end of last year, the proportion of bond and stock financing has almost achieved 30%. This slide shows the wide range of bond varieties in the interbank market. China's interbank market is essentially an OTC wholesale market participated by institutional investors. It is the main board of China's bond market, accounting for about 90% of the outstanding volume. Here we can see, besides the fundamental categories like rate bond, credit bond, there are also interest rate and credit derivatives, meeting the needs of risk control to a large extent. Let's look at the further breakdown of the credit bond registered with NAFMII. Here are the major types of bond: MTN, CP, SCP, ABN, ABCP, green note, etc. What I want to highlight is the green bond and SLB, sustainable linked bond. Here you can see the figures. The issuance volume of green bond reached 1.3 trillion RMB, and 56% of it is issued by corporates. And the bond issuer enjoy lower financing cost. Latest figure shows that the spreads between AAA green bond and other AAA bond is about 26 basis points. And also the tenure of green bond is longer than others. 60% of green bonds has a tenure of no less than 3 years. NAFMII this year launched innovative products like carbon neutrality bond and the sustainable linked bond. They reached 142 billion and 18.4 billion respectively. This slide shows the breakdown of investors. The investor base of the interbank market has diversified and now incorporates over 40,000 institutional investors, including all major banks, security companies, insurance companies, funds, and a variety of financial products. Banking institution is still the top one investor, about 58%, but it is 7 percentage points lower than it was 10 years ago. Asset managers are becoming increasingly involved in the market, with 29% of the interbank market bond held by wealth management products. Meanwhile, wealth management products are the largest holders of corporate bonds. Foreign entities now take up for about 4% of the total. Here, the liquidity of the China's bond market has also been enhancing. The trading volume is generally increasing every year, with while specific bonds turnover ratio are improving on yearly basis. Theoretically speaking, rate bonds are generally more liquid than credit bonds. This is also the case here in the interbank market. CDBs are the most liquid rate bonds. Okay, the second part, opening up of the market. This timeline shows the milestones of the opening up. For example, the official introduction of QFII and RQFII scheme in 2011 and 2013 respectively, and the connectivity of infrastructures like Bond Connect in 2017, etc. In all, the market is more friendly to overseas participants. Currently, overseas issuers, investors, and also intermediaries are gradually come to this market. In terms of issuers' opportunities, ever since the debut of the Panda Bond in 2005, China has amended rules and regulations to facilitate market development, allowing companies, foreign banks, multilateral institutions, and sovereigns to issue bonds. Panda bond market has been booming and is developing into a market with integrity, transparency, and efficiency for high-quality issuers. NAFMII has done a lot on developing Panda Bond market, explored and streamlined the rules on shelf registration, and propelled the policy adoption in key areas like accounting standards, tax, information disclosure, foreign exchange, and foreign debt accordingly in a pragmatic way. Latest figure shows that the issuance volume of Panda Bond is 370 billion RMB. And in the first half of this year, the increase of issuance volume is more than 20% on the year basis. We are pleased to see synergies between participation of overseas issuers and investors. The overseas investors holding proportion of Panda Bond is extending 20%, much higher than that of other categories and the NCDs. In individual subscription in the primary market of Panda Bond, overseas investors took up no less than 88% of the Panda Bonds issued by the Philippines, as well as over 70% of those issued by the province of British Columbia, and 55% of those issued by Hungary. Both overseas investors and issuers enjoy broader market access, and the number of interests is growing. In terms of the investor channels, Bond Connect and the CIBM Direct scheme have created new ways for overseas investors to access onshore bonds, complementing the long-established QFII and RQFII schemes. Both offer more convenience in terms of a streamlined approval process, no limits on investments and repatriation of profits, and the ability to hedge foreign exchange risks. These measures have been associated with a significant surge in inflows. At the same time, prospects for continued large inflows remain high, given that, firstly, inclusion into major index flows forecasted by Goldman Sachs is about $363 billion. And secondly, disparity of monetary policies of major economies will make you to offer attractive yields. This disparity has become more pronounced since the 2008 financial crisis, when QE and other unconventional monetary policies were adopted widely. The 10-year government bond yield average in the past 2020 was 2.94%. The comparable figures for the US, Japan, and Eurozone in the same period were 0.89, 0.01, and a negative 0.43, respectively. Thirdly, from the perspective of risk diversion, the correlation between China's economic performance and that of developed economies such as US, Japan, and Europe is relatively weak. For example, the correlation coefficient of GDP growth between China and the US is negative, whereas between the US and Japan and between the US and Europe, it is about 20%. So the right chart, similarly, the rolling correlation coefficient of government bond yields between China and the US is weaker than that between Japan, EU, and the US for most periods of after 2010. RMB bonds relatively independence is conducive to reducing portfolio risk and increasing expected returns. In terms of intermediary agencies, foreign underwriters and credit rating agencies are now active in the Interbank. I would like to add that the opening of the interbank market will benefit various types of institutions, and they are welcome to seek business opportunities here in this market. Well, to look forward, there is still great potential of this market to grow, and also lots of work have to be done to push for higher level financial market opening up, as well as market integration. Potential of market growth is large. After years of high-speed growth, China's bond market still has ample space to expand compared to other countries. See this slide. Firstly, debt to GDP ratio. As we mentioned just now, the market's outstanding volume still stands at about 110% of GDP, which is similar to Germany, but much lower than that of other developed markets. Secondly, ratio of RMB in the reserves. By the end of this March, RMB assets had reached an all-time high in foreign exchange reserves at 2.45%, but it was still far below the percentage of RMB in the SDR currency basket. To move forward towards a higher quality bond market, the reform agenda could be large, but should focus harmonize standards and practices of the domestic and overseas market. In this regard, we should consider both international best practices and domestic conventions. Let's take green and sustainable finance as an example. The practice of green bond registered with NAFMII is aligned with the international standards, and NAFMII has launched innovative products such as sustainable linked bonds to support transition of real economy. In the coming months, NAFMII will continue to align the domestic green bond practices by formulating China's green bond principles to call upon overall alignment with international green bond standards. Besides green, we do notice the rapid growth of the global sustainable and social debt market since last year. We will also draw on international experience and explore the possibility of introducing social bonds, sustainability bonds, and other products, guiding financial resources to focus more on areas such as low carbon transition and people's livelihood, and further foster ESG investors. Furthermore, China has launched a national carbon emission trading market. In this regard, NAFMII will provide trading-related documents to facilitate this market. Secondly, strengthen self-regulation of credit reading industry. For the well-regulated development of the credit reading industry, last month, regulators jointly laid requirements regarding improving the rating method system that can achieve reasonable differentiation with default rate as a code, as well as corporate governance and internal control mechanism. NAFMII has already eliminated the mandatory rating requirements. Also, NAFMII is in charge of conducting credit rating agencies' market-based evaluation, and will continue to make investors' voice heard and market reputation mechanism work by improving the evaluation system. Thirdly, enhance risk prevention and control mechanism. In terms of information disclosure, NAFMII formulated the implementation rules of corporate credit bond information disclosure and will conduct self-regulatory actions against issuers and intermediaries who violate under the principles of establishing rules, zero tolerance, no intervention. NAFMII will continue the efforts to strengthen self-regulatory actions and make and market discipline regarding misconduct of issuers and intermediaries, and make effective connection between self-discipline and administrative enforcement. Last but not least, enhance investors' protection mechanism. In terms of the secondary market regulation, NAFMII will continue to strengthen the self-regulation on false transaction, insider trading, manipulation of markets, etc., and gradually establish a compliant report processing, market analysis, and financial infrastructure information sharing mechanism to improve the disposal mechanism of bond default. NAFMII issued the bond default and risk disposal guide that provides a default proposal toolbox for both investors and issuers, and will improve the bond trustee arrangement and enhancing the efficiency of bondholders' meetings. Okay, finally, come to the two handbooks. NAFMII developed these handbooks with ICMA and market experts to meet demand from domestic and international market participants for an objective, comprehensive, and accurate source of information about China's bond market and Panda Bond market. Please allow me to express my gratitude to ICMA and all the market participants who contributed to these handbooks. These handbooks are officially released today.
I think we lost the connection of NAFMII. Yes, just to remind the attendees online, as the NAFMII's Qingren mentioned, we actually launched 2 reports together today. The mailing actually was released earlier this morning. Basically, the 2 reports, one is the investment angle, the handbook about how to access China's onshore market. So people feel free to access the report from both ICMA and NAFMII's websites. And also the Panda Bond case study actually is also a very good reference for those who are interested in the China onshore market to tap the onshore market from the issuer perspective. So the 2 reports actually are very good reference for both international investors as well as issuers. Okay, I think Qing is back. And I will leave you to introduce the first panel, which is a very good combination of different market experts on the Panda Bond. And I'm sure you will have a good discussion. Please kick off.
Okay, thank you, Rico. Let me introduce our panelists. First, Mr. Hu Kun, General Manager of Investment Banking and Management Department, Bank of China. The second panelist is Ms. Yang Xuemei, Deputy Senior Manager of Investment Banking Department of China Construction Bank. Third, Mr. Victor Dong, Treasurer, Greater China Region, Daimler, Vice President of Daimler Greater China Limited. Fourth, Ms. Ariel Yang, China Chengxin Rating Group, Vice President. Fifth, Ms. Christine Chen, Partner of Fonda Partners. And the last panelist is Mr. Wang Sheng, Managing Director, Deputy Head of Global Banking and Head of Financial Institutions Group, Hsbc Bank China Company Limited. Okay, let's start our discussion. My first question goes to Mr. Hu Kun. Bank of China deeply participates in the development of China's bond market and knows very well about needs and demands of overseas issuers. In what respects do you think this market is attractive to overseas issuers?
Okay, thanks, Madam Ren. Actually, from your...
Oh, sorry, voice cannot be heard.
I think we can move to the next speaker. Then when Mr. Hu is on, he can speak again.
My second question goes to Ms. Yang Xumei. China Construction Bank is one of the key participants in the Panda Bond market. As one of the writers of the Panda Bond cases study handbook, what are your suggestions to overseas issuers on how to make full use of this case study handbook?
Okay, thank you for your question. It is exactly what we want to share with Panda Bond participants. With the continuous opening up of the China financial market, the Panda Bond market has experienced steady expansion and development. As of now, there have been 64 successful Panda Bond issuers, including development institutions, sovereign and local governments, financial institutions, enterprises originating from Asia, Europe, and Africa. These issuances comprise a variety of bond types: traditional senior unsecured bonds, green bonds, ABN, perpetual bonds. Amid the rapid development of the Panda Bond market as a direct renminbi funding avenue, the market has accumulated a valuable experience and good practices through the concerted efforts of the regulators and market participants. These past experience will decide as we venture forward. Under the guidance of NAFMII, CCB contributed to the compiling of this bilingual guidebook titled Panda Bonds, Raising Finance in China's Bond Market Case Studies. The guidebook contains information focusing on the rules and regulations of the Panda Bond market, investor types, geographical distribution of issuers, and the issuance trends over the years. At the same time, it also showcases landmark and innovative Panda Bond transactions with detailed analysis of key deal highlights. This guidebook allows overseas issuers a quick and easy access looking for relevant past transactions with in-depth information such as deal highlights, innovative structures for the bonds featured, investor types, and other related issuance matters. This Panda Bond guidebook is highly informative and provides practical, concise, and useful information for overseas issuers who are keen to tap only be a valuable resource for the overseas issuers. It also provides important references to the overseas investors. The large number of high-quality bonds in China with relatively attractive yields will continue to attract more overseas investment flowing into China's bond market. The increase in foreign investors' participation in China's bond market will generate a positive feedback while creating a more conducive environment for both Panda Bond issuers and foreign investors. Thank you, Ms. Ren. That's all for this question.
Thank you, Ms. Yang. So my next question goes to Mr. Victor Dong. Daimler is the first Panda Bond captive issuer, witnesses broad up in the market. Based on your experience, what kind of benefits would the multinational gain by issuing Panda Bond?
Thank you, Madam Ren, for your question. First, I would like to thank NAFMII and ICMA for inviting me to share our experience in the Panda market. First, allow me to give you a short introduction of Daimler's business, particularly in China. So over years, Daimler as the leading auto group has introduced all our business into China market already, including the passenger car, the truck, and also our financial service business here in China. And since 2015, China is already the largest single market for Daimler, particularly for passenger car. And not a couple of years later, now we're talking about 1/3 of the sales units for the group on the passenger car is coming from China. So our success is building on overarching business strategy, which is we want to grow in China and for China. So this means we already have our largest R&D facility somehow next to Germany in China. We have the largest production facility here in Beijing to produce Custom Line, the E-Class, the SUVs, and also the battery vehicle. And very important, we're delighted to satisfy millions of our customers with our products as well as our financial service. Yeah, to finance this growth, we also want to follow this overall business strategy to really finance the growth in China for China. On the other hand, as a global player, we somehow have our bond programs across the globe, particularly in Europe, in US. So we want finally to get the instrument could tackle the domestic CNY market with the highest credit rating possible, which is Daimler AG, to give our investor on large scale the same protection. And also easy documentation, which could consistently could provide easy understanding and comprehensive for our investor base. So that's Panda, which is starting from 2013. We are very luckily to working with NAFMII, with our underwriter, Bank of China, and with variable market participants, be our law firm and the rating agency, to tackle the Panda, because it's very much in line with our business strategy, with our financing strategy, and very important that in the end, this will be a very much consistent approach for us to tackle the large investor base. So since then, we already getting more than 30 tranches in the market. As a very regular issuer, we raised more than 70 billion CNY in this market, and all of them to, in the end, finance our growth here in China and to satisfy our customers here in China. So this, to be honest, is the biggest benefit we get as a multinational, which we have a global presence and they have a very easy local touch on this point. And thank you, Madam. Back to you.
Thank you, Mr. Dong. My next question goes to Ms. Ariel Yang. China is pushing forward the reform of credit rating system to improve credibility and accuracy of credit rating and lower regulatory reliance on external credit rating. What's the impact of this reform on Panda bond market?
Thank you, Madam Ren. So first, I'll take the opportunity to thank NAFMII and ICMA for inviting us to attend today's panel. In the past years, we've been working very closely with NAFMII and all the different partners in the Panda bond market. So it's very good to see the old friends today again online. So back to the question, we know that rating is a very important part of the bond market infrastructure. So all the efforts to improve the overall quality of Chinese rating industry will no doubt contribute to the healthier development of the entire Chinese bond market. We know that in the past few years, a series of regulatory measures and documents have been issued, among which the most recent one, the joint published by the 5 major government institutions, urging the rating agencies to improve rating qualities, to build a test and verify mechanism focusing on default rates, and to formally roll out a more scientific rating system with more reasonable rating results. Very importantly, with better differentiation. So it's definitely the future and where we should head for. And for CCX, we've been preparing and get ourselves ready for that, because that will benefit everyone in the market. A better differentiation means better identification and positioning of risks, and which will lead to a more transparent, more scientific pricing mechanism for bond issuance. Of course, that including Panda Bonds. At the same time, the rating agencies will provide more in-depth research and analysis, more data, information services on the credit risks, and these will help investors with different risk appetites to navigate the markets, better balancing between risks and returns, and more importantly, to explore opportunities. So when we talk about the recent reforms of the Chinese rating industry, what we are talking about is, on one hand, respect and fully understand the uniqueness of the local Chinese market, at the same time to improve ourselves to the international standards, to gradually adopt the common language and common practice in the international markets. That is vital to the overall opening up and internationalization of the Chinese bond market. So a more well-connected Chinese market where international participants will feel very comfortable and convenient to explore would definitely help attract more people, including Panda Bond issuers. Back to you, Madam Ren.
Okay. My question goes to Ms. Christine Chen from Panda Partners. Ms. Chen, Panda has provided legal services to some overseas issuers for their Panda Bond program. Why professional lawyers are essential to the successful issuance of Panda Bonds, please?
Thank you. Thank you, Madam Ren. First, many thanks to NAFMII and ICMA for inviting me to this seminar. It's a great opportunity to share our perspective and experience with the industry participants. Myself and my team have assisted a number of international issuers on their Panda Bond offerings, including supranational issuers, for example, IBRD on their SDR bond offering, AIIB and ADB on their Panda Bond offerings, and sovereign and foreign government issuers like Republic of Korea and British Columbia, Hungary, Philippines, their Panda Bond offerings, financial institutions including Credit, Agricole, UOB, and also corporates like BMW. We have witnessed the development of this market, and it's great to say many of the issuers, after successful pricing and closing of their Panda Bonds, feel attracted to this market. And it's great to say many of them are actually coming back to this market and talking about the further issuance in this market and potentially different products. Why the legal counsel is important to the execution of a Panda Bond offerings, I believe law firms can be very, very helpful and to a certain extent critical to the deal execution process for certain Panda Bond offerings. First, international issuers typically before they move ahead for Panda Bond offerings, so they wanted to understand the legal and the regulatory framework in China around bond issuances. They also wanted to understand what's the concrete regulatory requirements and the regulators' expectations in terms of the steps and the documentation, and also they wanted to understand the full process for the deal execution, deal launching, pricing, closing, settlement, and clearing. So as a law firm providing legal services, we give them advice. We provide them with concrete information, particularly comparison between China onshore market, China's domestic legal and regulatory framework, and the market practices on international markets. And we, as a team, are experienced in debt offerings in the international debt capital markets. So we tell them, for example, how the bond is created. A lot of issuers ask that question, how the bond is created, whether the bonds are represented by a global certificate. No. And when can we do the deal roadshow? It looks like we have only very short window to do deal roadshow, right? And what's the publicity guidelines? What's the do's and don'ts for us to contact investors? And why the underwriting agreement has to be signed way before pricing, even way before deal launching. And so there are a lot of differences between onshore and international markets, but I found many of the issuers wanted to understand the differences and analyze the legal consequences, but most of those differences do not become deal killers. That's pleased, we're pleased to find out that. And for certain issues, they probably are not significant, but if you could provide helpful information or assurance, then that definitely will help them to just move ahead and not to be puzzled by a particular technical details. Just give an example, many of my clients ask, why, the minimum denomination of onshore bonds on the CIBN is 100 RMB yuan, right? 100 yuan is like a bond is denominated in that amount. And it's so small. I want that amount to be significantly larger. For example, equivalent of euro 100,000 or like US dollar 250,000 US dollar. Want to change it. So we tell them you can't. It's the market. It's the denomination. It's the smallest unit that can be traded on the market, and you can't really change it. It's market infrastructure. It's set up like that. But don't worry, because most of the time when they have this idea, it's just because when they do bond offerings on other markets, when they place bonds to professional investors, institutional investors, one of the way to ensure the investors are qualified financial institutions or professional investors is to make the denomination larger, right? And also that do not subject them to, for example, the Europeans like prospectus directive requirement. So because your purpose is this, we just tell them, don't worry, even if the minimum denomination is 100 RMB, is so small, all the participants on this market are professional investors. It's entirely institutional investor market. And also, if you look at the terms of the bonds, the minimum subscription amount is much larger, and typically it's set at 5 million or even 10 million RMB yuan. That's for the first subscription. You have to be, a much larger to get a subscription. So almost in all, such cases, when they asked this question, when we answered, when we know why they asked this question, we gave the answer, they feel comfortable. So it's a process of providing information to them, client education. Once they know more about this market, they feel more confident. And for us, we also provide services to the client in the structuring of the products and also in the development of documentation details, because a lot of products, when they come to when the issuer on the international issuer come to China's market, they leverage on their existing, for example, product features, or existing disclosure document, or even transaction document like the bond terms. For example, the status of the bonds, that's always consistent with the status of the bonds in their, for example, US dollar denominated bond or Euro bonds, EMTN program. It's always the same. But in the meantime, there are certain features of the product may be new in China. In that case, we'll help them to discuss the details of how to make them fit in China's market. So that's also.
Yeah. Okay. Thank you.
Yeah. Thank you.
Let's move on. My next question is to Mr. Wang Sheng. HSBC is a global bank and provides comprehensive service to overseas issuers in Panda Bond market. How do you think a global bank can facilitate Panda Bond issuance? Please.
Thank you, Madam Yuan. First of all, I would like to thank NAFMII and also ICMA for the invitation. It is a great honor to participate in this high-profile event alongside my distinguished fellow panelists. As you have just mentioned, HSBC is one of the world's largest financial institutions. We have a network of over 60 markets. Leveraging this global footprint, we have been able to promote the major themes of RMB internationalization, covering cross-border trade and also financing activities. And Panda Bond has been a core part of the efforts. Despite the fact the first Panda Bond being issued in 2005, and also financial institutions such as HSBC kicking start the market once again in 2015, there has been still many clients who still adopt a relatively conservative approach when it comes to the Panda Bond proposition, as is the case actually for any of the new market that they enter. As such, international banks such as HSBC contributes to the ongoing education and promotion of China's financial markets reforms to international players through local on-the-ground expertise, and also complemented by a global platform. HSBC ensures the latest China initiatives, especially those from NAFMII, are well understood by global borrowers as well as investors, wherever they are. Secondly, international financial institutions such as HSBC could act as the bridge between onshore and offshore, especially when it comes to suggestions surrounding harmonizing market standards, ongoing disclosures, product innovations such as ESG, SLB, etc., and also all these contributing to establishing best practices, in the market. After all, treating all investors fairly is a critical objective for all international issuers, and having the appropriate harmonization with offshore would only strengthen the appeal of the Panda Bond for both buy and also sell side. Thank you, Madam Yuan.
Thank you, Mr. Wang. So my next question goes back to Ms. Yang Xuemei again. China Construction Bank is one of the biggest banks in China. It is widely recognized that CCB is growing internationalized. In your opinion, what kind of high-quality services that Chinese banks could provide to overseas issuers? Ms. Yang.
Thank you. This is a topic that deserves a lot of discussion. From my point of view, bank underwriters should always strive to improve our international service standards, and particularly during this critical period of the opening up of China's bond market. As underwriters in the CIBM with the largest amount of credit bonds underwritten on a cumulative basis, we can leverage on our key strengths, riding on our leading market position and innovative experience to build a comprehensive and complete issuance process and services for the Panda Bond issuers. To date, CCB has successfully lead arranged Panda Bond transactions for the likes of World Bank, Asian Infrastructure Investment Bank, Daimler, BMW, Credit Agricole, etc. As bank underwriters, firstly, at the Panda Bond registration stage, we should rely on our established and effective communication process with the regulatory agencies, the collaboration with the investors and their comprehensive banking services to provide overseas issuers with an integrated, professional, and customized Panda Bond issuance solution covering registration, roadshow arrangement, and issuances terms and conditions. And other related services like global custodian services, bond settlement and clearing, foreign exchange and risk hedging, renminbi exchange rate derivatives, clearing and deposits we can all provide for foreign issuers. Secondly, at the distribution and pricing stage, the underwriting team of banks can leverage on the strengths of the head office, relying on our cross-border collaboration with overseas branches to better meet the Panda Bond distribution requirements of overseas issuers. For instance, CCB has established a global investment banking business center since 2017 to better serve our overseas clients and investors. We have set up bond distribution centers in Tianjin and Chengdu to cover the northern and southern regions of China. Besides, we have also built and developed our underwriting network in Hong Kong, Singapore, and Europe to provide overseas issuers with services for Panda Bond issuance. In addition, bank underwriters can rely on fintech solutions to close the constant information and knowledge gaps between the domestic and overseas markets. This will create an effective long-term exchange platform between onshore investors and offshore markets, and at the same time enable offshore issuers to effectively develop the China bond market as a reliable long-term renminbi financing channel. Thank you, Madam Ren. That's all for my part.
Thank you, Ms. Yang. My next question goes to Mr. Dong. Last year, NAFMII optimized the registration mechanism of Panda Bond. Daimler has already launched the debut registration and issuance under the new mechanism. How do you think the new mechanism will facilitate Panda Bond registration? Please.
Madam, thanks for your question. Daimler somehow is honored now once again leading the market. Yesterday, I'd be very proud to be the first issuer as a seasoned issuer in the Panda market. Let me summarize 3 points which our experience in terms of how we assess this mechanism. First, I think it's really provide the certainty to the market participants because the framework is quite comprehensive and the issuers and the other market participants could rely on the framework to prepare their work and to do the right assessment. Second, it's in our view, it's also provide quite a consistency towards the general framework. As I explained, we have a global approach. You could compare to the other markets practice. I think in that sense, it's quite consistent with the approach we are doing in the other markets. Thirdly, also very important as we do business here, it's really provide the flexibility because as a seasoned issuer with a basket of instruments we cannot tackle, including the public issuance as we go to the market yesterday. We still could choose the private placement rule with the ABS, ABN, and very important, it's also included the ESG feature into this one registration. For us, fairly easy to tackle at least from the infrastructure point of view, this topic in the future. So that's pretty much our assessment. And last but not least, very important is we go for public, and we definitely see a narrow down of the spreads, yeah, in our yesterday's deal. So back to you, Madam.
Thank you. Thank you. Ms. Yang, Ms. Avril Yang, in the process of opening up, in your opinion, what kind of role could credit rating agencies play? And what kind of value could the credit rating agencies provide to overseas participants?
Thank you, Madam Ren. So actually to answer this question, some of the points I think I've touched on in the first question. For example, we can help with the better pricing of different bond products. We can help with global issuers to reach a more diversified investor base. And we can help with better identifying risks and opportunities for the international investors. But one point here I would like to take time to stress is that the Chinese rating agency, we have a very deep understanding of the local markets. We have the first-hand knowledge of the local markets. We all know that China now is the second largest bond market in the whole world with great potential and very attractive returns. But international investors will find themselves many times facing with some uniqueness of this market, very different situations from any other parts of the world. For example, among around 5,500 outstanding onshore issuers here, nearly 85% of them, they are state-owned enterprises. And if we look at the total issuance, take the year of 2020, and that number will increase to 92%. So here comes the question. So many times we have been asked, and they will say, okay, who is the real SOE? Who is not? Who is the real LGFV? Who is not? And for example, in CSXI, we divide them into 3 different groups. Even generally, we all call them LGFVs, but then take any individual case by case. We will use different methods to rate them. Some will be accounted as LGFV, some will be like public service, but some will be, say, like a holding company. All that will be based on deep understanding of the real situation of issuers. And for example, in the same area, you may have several platforms, all claim to be very vital to the local economy. Then who is the real backbone there? Who is the really important one? And another perspective is that you have many different LGFVs from different areas, and then how to compare them, who is stronger. So we have like 30 years experience in the market, and for analysts, we have more than 400 analysts in total, and among them, we have more than 140 analysts just dedicated to the ratings and research of LGFV. So we cover the whole country, and we track and monitor them through the years, pay on-site visits, talk to the people, the management of the issuers anytime necessary. So we believe that our rating, knowledge, data, research, and professional services can provide the investors very important reference and tools. And also, as mentioned earlier, we are striving to enhance our rating industry now in China, and to be more professional, more scientific, and more in line with the international standards. So ideally, equipped with both local and understanding of the international rating skills, Chinese rating agency can help narrow the gap, the information gap for market participants during the process when the Chinese market is gradually fully integrating into the global market. So to round up, I think the Chinese rating agency who are in the middle of the reforms and improvement toward a more international standard will help enhance the ecosystem of the Chinese bond market. And we would like to act as a bridge to connect and help global institutions, both issuers and investors, to explore the Chinese market. Thank you, Madam Ren.
Thank you, Ms. Yang. My next question goes to Ms. Christine Chen. To my knowledge, some overseas issuers have intentions to explore bond financing in China, but are still hesitating since they are unfamiliar with China's bond market and regulations. Will you please update rules and regulations in China's bond market and give some suggestions to those issuers?
Thank you. Thank you, Madam Ren. First, of course, I would recommend to them, you need to find a good lawyer to provide advice on China's regulatory requirements, legal environment. In terms of Panda Bonds, these years have witnessed the development and involvement of the regulations and rules and the guidance in this area. Of course, for certain years, before actually 2018, for certain years, there are a number of, actually not a small number of Panda Bonds were actually issued without concrete written rules. At that point, a lot of issuers asked, what's a written rules? Can you just show us, and what's a concrete requirement? At that point, the reference was made to existing rules, regulations, guidance for domestic bond offerings. Of course, China has been criticized for lack of transparency in regulatory regime, for example, for Panda Bond for certain years. But the important thing is it is very important and critical to make sure rules and regulations, once released, are actually are working. That really means that written rules and regulations not released prematurely to impede the development of the markets. And we understand actually for Panda Bond rules that were released after rounds and the rounds of consultation with the market participants, with the potential issuers and the banks and law firms, accounting firms. So it is important to make sure rules, once released, can be implemented effectively. We're very glad to see that in 2018, September 2018, PBOC and Ministry of Finance jointly released Panda Bond rule, which actually serves as a fundamental high-level regulation in Panda Bond offerings. Subsequently, in 2019 and 2020, NAFMII published a number of guidelines for SSA issuers and for corporate issuers, including form requirements for disclosure documents for corporate issuers, which are very, very helpful. So for all these years in Panda Bond area, you will see increased transparency in the regulatory regime. This not only is witnessed by the publication of written rules and regulations, but also increased availability of user-friendly materials, including, for example, typically once NAFMII publishes written guidance on Panda Bond offerings. So for example, Panda Bond offerings by SSA issuers or corporate issuers and the form requirements, NAFMII will simultaneously release a convenient English translation of such guidance and form requirements. For many market participants or potential issuers, it's probably a small piece of transparency, but practically it's very important. A lot of issuers and their own domestic or their own local counsel can, study the rule, ask certain questions, and get access to these regulations. And also today's release of the case study on Panda Bonds, as just Madam Yang of CCB discussed, is also very hopeful to enhance transparency in this market, because a lot of potential issuers can study, these precedents by themselves and may ask helpful questions and to get more information. Last but not least, I wanted also to tell the potential issuers, the regulators in China are very, very easy to access, and they are willing to listen. They are reformist. They wanted to reform, open the market, so they're open-minded. Panda Bond, a lot of Panda Bond products themselves represent product innovations because they are new to China. But as you can see, over the years, many different features of the products are coming into the market, and after successful pricing closing of the transaction, issuers will come back again. So what you will see the attraction of this market, and that also demonstrates the regulators, their vision, their accessibility to the issuers. So I would advise the potential issuers, if you have any concerns or questions, find a good bank, find a good lawyer, and very importantly, establish communication channel with the regulators and talk with them about your concern. And most of the time that can be addressed. Thank you.
Okay, thank you, Ms. Chen. As time is limited, my last question goes to Mr. Wang Sheng. As a global bank, Hsbc is deeply rooted in the overseas market and also knows quite well about the domestic market. So are there any suggestions on the further development and opening up?
Thank you, Madam Ren, and that's quite a compliment for HSBC. Thank you very much for that. I think, the regulators, PBOC and NAFMII, has devoted a lot of efforts and consideration to the development of the market. So we at HSBC is extremely optimistic about the potential of the Panda Bond market development. Recent regulatory directives in constructing a high quality debt capital markets were also very much welcomed by international stakeholders. As the Panda Bond ecosystem becomes more refined, for example, book building has added transparency, product spectrum broadened, and the renminbi being included in more global fixed income indices, we are very much confident that the Panda Bond market would continue to reach new heights and flourish. Looking ahead, issuers will be looking forward to whether further progress could be made in aligning onshore and offshore practices. For example, whether the number of joint lead underwriters on a particular transaction can have some flexibility. This would enable international financial institutions to have more opportunities to complement the Chinese peers, creating a win-win-win situation for the market, the issuers, and also the investors, further contributing to the high-quality two-way financial market opening up. Thank you, Madam Ren.
Thank you very much, Mr. Wang Sheng. And I would like to give my appreciation to every panelist. Thank you very much for your insights and suggestions. Very impressive. And after this panel discussion, I think we realized again the heavy tasks we are shouldering, because there are still a lot of differences between market practices, and also there's a large space for improvement. I think this is the reason why we should work together more closely to prepare the interbank market and provide to overseas participants more professional and high quality information and services. For those potential participants, again, welcome, and I hope our discussion will be helpful to you, and hope overseas participants could come to this market and enjoy this market. I would like to borrow Mr. Victor Dong's words that we hope you could enjoy this market, participate in this market in China and for China. Thank you all. Thank you.
Thank you, Qing, and all the panelists. It's a very good discussion about the Panda Bond, and it's good to see the development of the Panda Bond market over the last few years. And I'm sure it will continue to grow. And I think the convergence of the market practices is something we work very closely with NAFMII as well. And move on to the investor angles. As people know already, there are 3 channels to access the China's bond market through different channels. So they are Bond Connect, CIBN Direct, as well as QFII, RQFII. So as mentioned, we have such handbook launched this today to basically give a comprehensive picture about how to access the China's market from investor perspective. And I'm very honored to introduce the experts in the market to give details about each channel and let you have a clear picture about what's happening right now and how you can achieve to access the Chinese onshore market. So first, let me introduce Bond Connect Limited. The representative is Phoebe Leung, Senior Vice President and Head of Sales Marketing. So Phoebe, I hand over to you. Thank you.
Thank you very much, Rico, for inviting Bond Connect. So first of all, and most importantly, I'd like to congratulate NAFMII and ICMA in the publication of the CIBN handbook. I'm sure investors around the world will hugely benefit from the depth of insights it's able to provide. Now, the handbook is titled Investing in China's Interbank Bond Market. So undoubtedly it is, if not already, one of the most heated topics in the global markets at the moment. So China's fixed income markets has unfolded itself with growing significance in the process of global asset allocation, especially in the backdrop of the recent worldwide economic fallout from the COVID-19. As investors seek for alternative high-quality defensive assets, the attractiveness of CGBs, policy banks, and other RMB assets stood out from the crowd. Now, more importantly than ever, is a time where global investors are looking into the CIBN, how it works, how to assess, due to a few compelling factors, including the attractive valuation and yield spreads against other global sovereigns without strength of economic recovery from the pandemic. And definitely the low correlation between China and other major DM is also another attraction for risk diversification. And lastly, definitely, the appreciation potential of the RMB and its increasing role as an SDR currency. Next slide. So in the last 20 years, various asset schemes have been launched to progressively embrace international capital into the onshore bond markets. The earliest schemes were categorized by its quota constraints, investor location constraints, the necessity of multiple regulatory approvals, agency trading model, complex repatriation process, and lengthy infrastructure setup in onshore. We started off with QFII in 2002, RQFII in 2011, and CIBN Direct in 2016, which definitely evolved from the 3 types of financial institution scheme from 2010. Now, as time goes by, it is no longer foreign central banks, or AMs in the region that is participating in the onshore bond market. So interest was brewing from all over the world: banks, AMs, pensions, insurance, hedge funds. So it was a time to call for an asset scheme that is able to provide the most investor-friendly bridge to the CIBN. And coupled with PBOC's strong will to internationalize China markets infrastructure, this prompted the development of Bond Connect. In HKEX's design of Bond Connect, we were given the task to increase foreign holdings from 1.6% before we were launched to a long-term goal of 15%. And today, we have reached 3.4% with 3.7 trillion RMB of foreign holdings in Chinese fixed income assets. That is actually a 3 times growth from 2017. Next slide. So Bond Connect has always been seen as a breakthrough in China mutual market assets, one of the crucial steps in achieving the goal of RMB internationalization. and definitely a key tool to accelerate the inclusion of Chinese bonds in global indices, such as Bloomberg Barclays, JP Morgan, and most recently, the FTSE Weekly. Southbound trading has gone live today, and northbound trading has been launched since July 2017. Now, the design of Bond Connect eliminated quota constraints, agency trading model, and the complexity of account opening process in the traditional models. It takes on a global DM architecture, which is based on the integration of the international trading and custody infrastructure base, allowing to really operate under international practices. Now, Bond Connect is categorized by its trading link and settlement link. First of all, the design of trading in Bond Connect utilizes international access platforms, as you can see from this chart, such as TradeWeb and Bloomberg, which interfaces directly with the onshore fixed income trading platform, CFAX. Investors can now gain full autonomy in the trading without the need of agents' input like the traditional models. This definitely eliminates human error and losses that can be caused by untimely handling. The Bond Connect investors are able to trade RFQ with 56 onshore market makers spanning across onshore banks and securities. Being an open infrastructure like ourselves, we are also in the process of adding more e-trading platform in the very, very near future. Now, in terms of a settlement link, very importantly, investors are not required to open accounts in China for their bond holdings. Instead, they hold their CIBM bonds through the global and local CMU custodian banks via the Hong Kong Central Bank HKMA CMU's nominee accounts, completely integrating a global custodian approach. So CMU as a nominee maintains securities accounts with the two onshore CSCs. And with this simple arrangement, investors are assured of direct beneficiary ownership for their bonds, and also eliminated the need for them to contract with an onshore bond settlement agent or cash custodian like the other SS schemes, which operates under the PRC laws, by the way. So in this case, all cash accounts and operational flows in Bond Connect can now be maintained offshore with zero cash exposure in the onshore banking system. Next slide. So onboarding is also made much simpler with Bond Connect companies' dedication in the whole process. So in the last 4 years, we continually simplified onboarding in partnership with PBOC and CFAX. Investors are now able to conduct entity-level application through our electronic filing system. And we have also been in the forefront to educate and guide investors through the whole filing process and help them with preliminary reviews. The average turnaround of Bond Connect application is now about 3 to 4 weeks, with the quickest approval seen to be 3 days post-submission. So on the next slide, all in all, I would say whether it's from an application process, bond ownership structure, to trading protocols, a comparison of Bond Connect across all the traditional asset schemes has led to a very wide perception that Bond Connect is more direct, it's easier, and it's faster. Bond Connect investors are able to trade with a full universe of cash bonds in CIBM, alongside with a suite of onshore FX hedging tools for the risk management. Next slide. Okay, so Bond Connect's ease of adoption have really led to a steep momentum in its growth as a major and new investment channel for investors in the last 4 years. On a year-on-year basis, the number of Bond Connect accounts opened actually gave a 30% rise to 2,945 today. These accounts actually span across 736 entities across global banks, asset managers, insurance, pensions, central banks, sovereign wealth funds, hedge funds, securities, family office, the list really goes on. And emerging as a strong trend is also the increasing filing from ETF and ESG funds on Bond Connect. The demand from asset owners remain very high, with a very evident, strong onboarding pipeline to follow. So next slide, we're going to be talking about the expanding network for Bond Connect. I would definitely say the network is strongly attributed to the word of mouth of investors. This year, we penetrated 3 additional markets, including Brazil, Norway, and Kazakhstan, resulting in our far-reaching investor coverage to 37 jurisdictions globally. So looking to the chart on the right-hand side, we are obviously not just driven by activities within Asia, with 33% of investor base actually comes from US, followed by Hong Kong, UK, Singapore, Japan, Luxembourg, Canada, etc. We're actually also seeing more solid interest coming in from Latin America, Middle East, and even Central Asia, achieving a true international base. Next slide. Okay, so we have seen the investor adoption trend. We have seen the global coverage trend. Next, how much trading are we really facilitating? So those of you that follow us closely must be quite recently bombarded with our headlines about our historical high trading volumes. So after a 50% annual ADT growth in 2020, we are actually at about 26.5 billion ADT so far this year in 2021, which is about 4 billion in US dollar. In June this year, we saw the highest monthly ADT at about 30.5 billion RMB. And we have also once broken a record single day trading volume of close to 50 billion in April. That's about 7.8 billion in US dollar terms. And just quickly on the next slide, we'll be able to see that investors have been actively trading across the curve in a variety of bond types. In the current rates environment, roughly 45% of interest goes into CGB, 35% on average in policy banks, 10 to 15% in NCDs, and the residual in credit bonds like CPs, MTNs, corporate bonds, and even ABS. So with the FTSE inclusion just 1 month away, we will not be surprised if we reach 50 billion RMB ADT in the next year. Next slide, please. Okay. The development of Bond Connect continues definitely with our pivot role in the whole RMB internationalization process. A lot have been done in the past year to continue improving the whole market infrastructure. We have pushed for an extension of trading hour and settlement cycles, enabled all-in price payment model. We further simplified onboarding and pushed for third-party FX. To pave way for our ambition to extend our footprint in both the onshore and offshore primary markets, we have launched our latest proprietary system called ePrime. And just 2 weeks ago, we also announced our new FX system, which is called the CNY Plus, to help investors and FX banks to manage investors' FX funding and hedging needs. And just today, not to mention the self-bound Bond Connect. We will definitely be working on further enhancements to ensure investors of an efficient access and a full suite of fixed income investment and risk management tools. And on the final slide with our contact details, I'll wrap up my presentation here. So if you have any questions and want to engage with us for a deeper discussion, please feel free to reach out to us anytime. Thank you, and I hope you enjoy the rest of the conference today. I hand over back to you, Rico. Thank you.
Many thanks, Phoebe. That's a lovely presentation about the Bond Connect, and congratulations about the successful launch of the southbound in particular, and also overall the volume trading with the Bond Connect. So next, let me introduce the team from King & Madison. They are David Mu and Stella Wang. They will give a presentation on CIBM Direct. So David, Stella, the floor is yours.
Okay, thanks very much, Rico. And we are very grateful to be here. And thanks for the invitation of ICMA and NAFMII. It's our great honor to present the CIBM Direct. Because we have helped CIBM, ICMA and NAFMII in relation to Section 4.2 of the handbook just mentioned by Madam Ren. I would like to echo what Phoebe just said. CIBM Direct was launched in 2016, 1 year ahead of Bond Connect, and grows rapidly as one of the major CIBM Direct CIBM Access Program. Unlike the Bond Connect program, which was built up on a nominee account structure, CIBM Direct allows foreign investors to open their accounts, trading accounts, bond account, and cash account onshore, and with onshore banks and with onshore registration and clearing institutions, including CCDC and the Shanghai Clearing House. The next slide, please. This is the overview of the 3 channels Phoebe just mentioned, and we are going to cover the middle one, the CIBM Direct. Next slide, please. A wide range of overseas investors are invited to enter into CIBM Direct, CIBM market, including foreign central banks, international financial institutions, foreign wealth management funds, and the foreign financial institutions and their investment products, as well as long-term and mid-term institutional investors. Before a foreign investor can invest in CIBM through the CIBM Direct, they have to appoint a bond settlement agency, and the bond settlement agency will carry out all KYC and know your client and know your business and the due diligence work before they onboard a foreign client, a foreign investor. And after that, the bond settlement agent will help the foreign investor to file with PBOC and the SAFE. And after that, the bond settlement agent will help the foreign investor to open onshore cash accounts and other bond accounts with Hsbc and the Shanghai Clearinghouse, as well as the trading accounts with CFET, the China Foreign Exchange. And a CIBM Direct allows investors to trade a full scope of products in the CIBM market, including spot bonds products, bond forwards, RS, interest rate swap, foreign exchange derivatives, and other products, on the condition that those derivatives will be entered into only for a hedging purpose. It is worth noting that bond repo is yet to be open to most of foreign investors, except for central banks, renminbi clearing and participation banks. And I would like to mention that onshore repo products are significantly different from what we see in overseas or international market. In the international market, we see repo are documented under, for example, GMRA documents, and it's based on title transfer, single agreement, closeout netting. But onshore, in the onshore market, bond repo are documented by NAFMII Repo Master Agreement. There are 2 types of bond repos, including the pledge style bond repo and the title transfer, outright transfer bond repo. The pledge style bond repo dominates the onshore market. Next slide, please. Repatriation is very flexible, and the PRC regulators just want to avoid the FX arbitrage. So the outbound repatriation shall be largely kept inconsistent with inbound remittance of the money. And enterprise income tax has been exempted for 3 years since 2018, and whether the EIT exemption will survive the expiration in November this year is still unknown. One of the most exciting merits of the CIBM Direct is that there is no quota limit for the whole channel or for the individual investors. It was very attractive compared with QFII and RQFII back in 2016, because then time QFII and RQFII are still subject to quota limit, but now they are gone. Lastly, I would like to share some observation on other use of your holding in CIBM bonds through CIBM Direct Access. According to the record published by the PBOC, there are more than 400 CIBM Direct investors and their investment products that have been registered with the PBOC and are investing in CIBM market. And the foreign investors are keen to look into potential opportunities to make better use of their onshore holding of the CIBM and other renminbi bonds. And they are asking questions to us whether we can collateralize our onshore CIBM bonds for other overseas transactions, including derivatives transactions. We helped ICMA and the CSDC. We have the ISTA and the CSDC on a white paper published this year on the use of renminbi bonds as initial margin for overseas international derivative transactions. And that one was well recognized and welcomed by the market. Although there are a lot of obstacles and challenges to overcome, we are very glad to see that some of them have been dealt with or lifted by onshore financial infrastructures. For example, the enforcement, because in the past we only have some difficult enforcement measures, but now we have some fast self-remedy enforcement measures. Now I would like to introduce our partner Stella Wang, who will share with us some introduction on the self-remedy enforcement measures in the CIBM market. Stella, over to you.
Okay, thank you, David. Hi, everyone. By way of introduction, I'm Stella Wang from Kenwood Medicines, and thanks for ICMA to give us this opportunity to share our thoughts in this seminar. So further to David's speech, in addition to the investment nature of RMB funds, I believe how to utilize the bonds is also a very key consideration to the foreign investor, in particular whether the bonds can be used as collateral, as just mentioned by David, whether it can be used as the RMB margin. Actually, the most important factor to facilitate the utilization of RMB bonds depends on whether the enforcement of collateral can be done quickly and effectively. Given this, the financial infrastructure enterprises such as CCDC, CFATS, Shanghai Clearinghouse have published the bond collateral enforcement rules. The main intention is to provide the creditor quicker enforcement remedy to solve the default scenarios. Before the announcement of default rules, when the creditor take pledge over the bonds in China, usually the parties shall go to the court to get a favorable judgment first, and then enforce against the pledge draw under the court's organization of auction. Apparently, the creditor shall go through a tedious court procedure, and the value of the pledged bonds may reduce during that period. However, after the default rules come into effect, with the assistance of the financial infrastructure entity, the creditor is able to use the so-called self-remedy enforcement without going through court. Generally speaking, the infrastructure entity will organize the auction as per the sole application of pledgee only. In respect of the pledge draw, it shall give the authorization or the delegation to depose its bonds on day one. In this regard, there is no need to seek the pledge draw's further consent upon the enforcement, which means that the creditor can enforce the pledge itself without seeking cooperation from the defaulted pledge draw or the borrower. So it's nearly 2 years since the circulation of the default rules. As far as we know, there are many precedents under which the creditor successfully disposed the pledged bonds in a very quick manner. Usually, it just takes 4 or 5 days. Kenwood Medicines also have been deeply involved in the preparation of these enforcement rules. As you may know, the PRC collateral-related legislation are changing from time to time, especially upon the civil code coming into effect this year. So there are a lot of detailed technical points and mechanisms to be further explored. Looking forward, I believe the more robust and creditor favorable enforcement rules will be established in the near future with the development of Chinese legislation. Okay, thank you.
Thank you very much, David and Stella. That's very comprehensive introduction about the CIBM direct scheme. And next, let me introduce Kimmy Liu and Terry Young from Cliff Chance to introduce about the QFII system. Over to you, Kimmy and Terry.
Thanks very much, Rico. I think just to echo all the speakers that have spoken so far, obviously it's been a great honor to have had the opportunity to contribute to ICMA and NAFMII's guide on what is absolutely a massive topic and really a topic that's too big for international investors to ignore. Given timing, I think we'll try and keep this section quite short. I'll hand over to Kimmy shortly to give a brief introduction to the topic as well as what we cover in the guide. I think one of the things that I would just say at the outset is I think this would echo all the other contributors as well to the guide. Is the guide, I think we're very proud of what we've put into the guide around the QFII regime and around the comparison between different channels. But obviously the guide is not meant to be a comprehensive sort of encyclopedia to the topic. It is an introduction to the features and what, at least in our experience, when we've helped clients navigate. And the PRC market has been one of the trickiest markets in recent years to navigate because there's been a huge amount of regulatory developments in one of the fastest growing economies, major economies in the world. So rightly so, there are a lot of tricky issues emerging. Just pick one very quickly. We see regulators nowadays looking being more interested and looking more into the type of market access products that QFII participants are offering in the offshore market. But we are also encountering a theme in the international markets and also in the PRC around data sovereignty and keeping sort of information of that nature, holding that quite tightly. So we're seeing this sort of increasing obviously the need to open up the PRC bond markets, but also this increasing tension between various strands of regulation, and that leading to issues that we need to help our clients digest. So very much an interesting area, the QFII regime being one of the biggest, the merger of the QFII and RQFII and the development being one of the biggest developments in the PRC last year in 2020. So without further ado, let me hand over to Kimmy to give a bit more details on this channel, that very important access channel to the PRC bond market. Thank you.
Thanks, Terry. Hello, everyone. So as Terry mentioned, I will give a little bit more details about the QFII regime. So historically, we talk about the QFII and RQFII. So the differences are, so basically, which stands for RMB. These two regimes was launched in 2002 and 2011, respectively. QFII started first, then followed by RQFII. There's a broader background of internationalization of RMB. But as Terry mentioned, nowadays, since last year, these two regimes have been kind of combined into a single regime. This has been demonstrating PRC regulators' efforts to streamline those access programs to the PRC financial market. And since its introduction, the QFII regime has been served as a key channel for international investors to access the PRC securities market. Given its track record of almost 20 years, it is already a quite important and also well-known channel for international investors to invest in China. And with the introduction of the RQFII regime and the latest development, we have seen a lot of further relaxation. So this is also consistent with the policy trend in other regime and also the channels for CIBM investment that our colleagues from Bond Connect Company and the Ken Medicine have already introduced. So for my part, I will quickly run through three key issues for the QFII-RQFII regime. The first one is market access, the second one is structure, and finally, we'll cover some key issues under this regime. So for market access, still, for an international investor to become eligible under the QFII regime,
it need to apply for license from the securities regulator, the China Securities Regulatory Commission. There is a license to be issued, but based on our observation, so long as you can satisfy those eligibility conditions, is a quite kind of simplified process now. And we have seen PRC regulators act quite responsively and can quickly grant the approval, so long as mentioned the conditions are met. And even for the eligibility conditions, there are great improvements since last year. Previously, there are some kind of hard numbers people need to satisfy, but in the latest rules, there are more flexibility. So the regulators will look at the overall eligibility of an applicant and can make a decision by considering a lot of elements, not numbers alone. So after getting the CSRC approval, an applicant also need to complete the registration with the foreign exchange regulator, and also to open accounts with onshore financial market infrastructures. Then for CIBM, accounts need to be opened with the CFAX, need to be opened with the CCDC and the Shanghai Clearing House. Those are central depositories. So for the market access, different from Bank Connect and the CIBM Direct, this is more like an onshore channel. So after getting all of these license and the account opening and the registration, a QFII operates more like an onshore trading participant because of its structure that I'm going to cover. So in terms of the structure, for a QFII investor, it will need to engage an onshore custodian bank to take into custody the assets and cash under the QFII regime. So onshore accounts, both cash accounts and the securities account, need to be open. So for CIBM investments, a QFII will need to open an account directly with CCDC and Shanghai Clearing House, as mentioned. Then at the current moment, QFII still need to engage a settlement agent to take care of the trading and the settlement aspects of the trading. So this is basically the structure of the QFII model. So not that fundamentally different from an onshore investor. In terms of comparison with Bank Connect and CIBM Direct Access, indeed, you will see that in terms of the structure and also kind of market access procedures is indeed more burdensome, and people need to do something more and will kind of more regulatory formalities to tackle this. But QFII still has its advantage, because besides CIBM investment, a QFII will also be permitted to make investment into other markets in China, including Asia market. And if under the latest rule introduced last year, the investment scope of QFII has been broadened as well. So there will be a lot of other opportunities available under the equity market, and also for some commodity futures and financial futures, this will also be within the scope. In the guidebook, definitely there are more details I will not repeat here, but just one observation is that also regulators announced the kind of relaxation of investment scope, but in several key areas, people are just taking a step-by-step approach. So although the rules are clear, but for example, for some commodity futures investment, this will be subject to further regulatory kind of green light. So people are still expecting more flexibility, but still the QFII model may also be kind of further involved in the near future. So in terms of the last topic under the QFII section, we also highlight several key issues for people to consider under the QFII regime. So the first issue is more about the remittance and repatriation. So I have mentioned that the QFII regime is more like an onshore trading arrangement. So repatriation and remittance has been historically an issue, but nowadays, actually with the removal of quota and also the combination of two regimes, what we see at this moment is that for remittance and repatriation, the regulatory restriction has been reduced to minimum. but still, a QFII need to work with a custodian to work out those foreign exchange formalities. The second issue is the non-trade transfer. I think people may be curious about how the QFII regime can interact with the CIBM regime. Madison Coy introduced just now. And indeed, even for the STEM investors, they may open different accounts under these two regimes. And also in 2019, regulators actually introduced a non-trade transfer mechanism between these two regimes to help people kind of streamline their investments in China. And based on some past operation, we understand that if this gives market participant a channel to kind of transfer their position between these two regimes as some kind of solution to reduce those kind of transfer costs. And the last issue people have been talking about is the beneficial ownership. Because of the use of onshore custodian, as we mentioned, and also this special requirement for account opening, this has been an issue that people have discussed a lot. And I think the positive aspect is that the naming convention of those onshore accounts basically can satisfy people's requirements to designate the ownership of those assets. So people can have like a QFII-fund name structure, like QFII-client name structure for those account names, and also in multiple regulatory announcements, and also based on a lot of feedback from regulators, I think the position of ownership now has been relatively clear. Although the PRC's civil law system may not be identical to those kind of common law system, and theoretically there may be some further work to be carried out, but at least based on our observation, the beneficial ownership issue is no longer something kind of a concern, and this shall not kind of prevent people to kind of gaining more interest for this regime. So probably because of the time issue, probably I just stop here. Then definitely we are happy to discuss with members, with audience of today's webinar to further discuss those kind of issues under the QFII regime. And thanks so much for ICMA for arranging all of this. Probably I will just hand over back to Rico.
Thank you, Terry and Akimi. That's a very good summary about the QFII system, and I think different investors will appreciate the different channels. They have their own advantages. I think the investors can evaluate which channel would be most suitable for them to access the Chinese onshore market, or maybe even more than one. Again, I want to remind the people who are still online, we have one panel to go, and actually we just finished the presentation about the 3 channels, particularly included in our handbook. So you feel free to access the handbook through ICMA and NAFMII's website, and they have full details about how to access the Chinese onshore market. And the last panel would be the investor angle to participate in the CIBN. Let me introduce my panelists first. I hope you can switch on your video. They are Becky Liu, Managing Director, China Macro Strategy Head at Standard Chartered Bank. Zheng Liu, Senior Deputy Manager at the Global Markets Department with ICBC. And last but not least, Henry Yip, Managing Director, Head of FICC Sales, CITIC Securities CLSA. So the first question maybe to all of you. Recently, as you probably note from the news, that there's a controversial topic to basically to increase the investment to the Chinese onshore bond market. So BlackRock's research unit has said recently that China should no longer be considered as an emerging market, and recommended investors boost their exposure to the country by as much as 3 times. Meanwhile, as you know, George Soros has the opposite view. So I'm just curious about each of you will share which side, and basically, so what are your views on this? Maybe I start with Becky.
Sure, thank you. And thanks again for having us here. From our perspective, we firmly agree with the BlackRock view that we do feel China market in terms of both exchange rate, the CNY, as well as the fixed income market itself are more similar to a DM market rather than a EM market. But of course, you still have a certain segment of this market that's more similar to the EM market, especially on the credit portion. So first of all, from the FX perspective, the CNY is a SDR currency, representing its role as a international reserves currency. And at the same time, if we just look at the secondary market liquidity for both spot and swap, it's very similar to G7 or G10 currencies. Then the CNY and CNH altogether also have a wide suite of derivatives that international investors can use to hedge their FX exposure. And some of these derivatives has already become quite liquid. A few months ago, I think London has published some result in terms of local derivatives turnover. And the result was that CNH options turnover was exceeding that of Japanese yen options turnover. So you could see that from a liquidities perspective, CNY and its associated products are already quite similar to the G7 or G10 currencies. And from the fixed income markets perspective, it's very similar. First of all, its size. If you add up foreign investors holding in the entire EM Asia or the rest of Asia, except for Japan, that you see that foreign holdings in all of those local currency bond market are still smaller than their holding in the China market. Although we say that the foreign ownership in China's domestic market is only 3%. So first as size, it's hardly able to find any size in the EM market that could give you the same size as China market. And second is the secondary liquidity. If you look at the CGBs, for the on-the-run bonds, oftenly they're trading at a 1 basis point bid offer. For certain benchmark names, they're trading at even a quarter of bid offer. So for this kind of liquidity, it's also very difficult to be found in other EM markets. And during some period of liquidity stress, we had even seen the CGB's liquidity in the secondary market exceeding those of the US Treasury market at a point. So from this perspective, this market is indeed more similar to the DM market. And lastly, there are also other reasons. One of the primary reasons is volatility. China market exhibited much lower volatility in both FX and rates compared with most of the EM markets. And at the same time, under the channels that our experts has just described, there are barely any capital control. So under stuff like Bond Connect, CIBM, or to some extent QFII, RQFII, there are very little capital control when foreign investors are pulling in or out of the country in their capital investments. Thanks.
Thank you, Becky. So Chen and Harry, I assume you will share the same view.
Hi. First of all, I would like to thank you on behalf of CITIC CLSA. Thank you, NAFMII and ICMA, for inviting us to participate in this meaningful event. And we're looking forward to the similar conference in the future. And get back to your questions, whether China should no longer consider as an emerging market. I think it's really depends on how you look at it. I mean, if you are arguing about the capital, the income per capita, or like the capital control, or even the infrastructures onshore, etc. But I think we should look at it from the liquidity and the asset class that it can provide, and the market cap, most importantly, because as you can see, the China bond market has already become the second largest market in the world. And but the offshore holdings are only up to 3% of the total outstanding right now. And even though the CGB offshore holding is up to 10%, but if you compare to other developed countries or even like emerging markets like Indonesia, our number is absolutely low. And if you look at the weighting in the global bond index for China, it's also cannot compete with the other developed countries. For example, in the Bloomberg Barcaps global index, China is only, the renminbi is only account for like 6%, whereas Japan's it's, over, 13, and Europe maybe 23. So in this case, I think if the exposure puts up to like 2 to 3 times, which is still a reasonable level to compare to the peers. And not to forget, right now, globally, the negative yielding debt, it's about $13 trillion compared to last year's 18, I think. But for a single A rated country with 10-year government bonds at 3% yield, is unheard of and only exists in China. And with China now included in all three major global bond indexes, as we all know, the FTSE Russell already confirmed the CGB will be included in the WGBI from this coming October, and the weighting should be around 5.25% for the next 36 months. So the potential allocation to Chinese assets from the global central bank's reserves will be significantly increased. Simply because the central bank these days have become more return-seeking. They have been reducing their holdings in the traditional assets in the DM while increasing the emerging market govies and even corporate bonds. And the returns on CGB outperform all the traditional reserve fixed income markets over the last 5 years. So as much as the index will draw the passive inflows because of the index weighting, I think the valuation and the characteristics of China bond markets will give you the alpha, give you the returns and the diversifications. As you can see from the March of last year, the volume of China bond markets was almost unchanged, while the rest of the world sold off a lot. So along with the continued loosening stance, I think the onshore bonds will keep offering the attractive potential capital gains or upside with carries. Thank you.
Yes, so June, please.
Okay, thank you, Rico. It's truly a pleasure, great pleasure to attend this event, and thanks for the invitation. I think BlackRock's research, in a sense, reflect that overseas investors' growing interest and focus on China's market. On the bond market side, we all know that CIBM now is the world's second largest bond market and attractive to overseas investors with its competitive yield level and low correlation with other markets. And the outbreak of COVID-19 has brought great shock to global economy and financial markets. And China has made great progress against the pandemic. China's macroeconomy has been quite resilient with steady recovery, which lays the foundation for investors to increasing allocation in RMB assets. And like just mentioned, the global bond index inclusion is also being an important stimulus, especially for asset manager. To now, the three major indices has all started to already complete the inclusion of RMB bonds. And FTSE Russell also confirmed that the phasing of RMB bonds will soon be effective since this October. Currently, there are over $2.5 trillion tracking the FTSE Russell WGBI index. And a successful inclusion would definitely be another milestone event for CIBM. And as the largest local market participant, top market maker, from our experience with overseas investors, we do feel that the onshore markets is receiving much more attention from overseas investors. Till now, we have been trading CNY bonds with more than 600 foreign investors from nearly 60 countries and regions. This year, the trading volume of our clients in CIBM increased by over 70% year on year to August. And looking at the market status quo, till the end of August, 981 overseas investors have joined the market. The total holding balance of overseas investors reached 3.8 trillion yuan, increasing by about 40% year on year. Especially this year, with the spread between China and US Treasury getting convergence, we still see continuous net inflow in the first 8 months. And the overseas investor stake in CGB now reached 10.7%, picking up to a record high. Generally speaking, overseas investors are now becoming more active in CIBM than ever. Thank you.
Thank you all. I think that's clear message that the CIBM is very attractive to the overseas investors with the stability of currency, index inclusion, etc. So we have touched on a few important facts about why the China onshore market is so attractive. So Becky, I want to turn to you again. In the past few months, the yield on 10-year CGBs fell to below 3% in reaction to China's easing signal. while the US Federal Reserve was set to tighten next year. To what extent does this narrowing spread between the CGB yield and the US equivalent affect the attractiveness of Chinese bond to international investors?
Thanks, Rico, for the question. Valuation is only one of the factors when foreign investors are considering their China bond investment, but valuation does have an impact in terms of short-term capital flows or short-term purchase of China bonds. For example, since the decline of China bond yields below 3%, we do have seen a slowdown in foreign inflows into China's onshore bond market in both July and August. But we believe the reason we go beyond that, there would be concerns about a faster than expected economic slowdown in China, and also concern that the relatively slow pace of easing might not be sufficient to address such challenges. But more broadly, when we look at the overall picture, when foreign investors are considering the China bond market, we first need to look at the type of investors. So since a few years ago, since the CIBM program started, at that time, the primary foreign investors were primarily public sector investors, including foreign central banks, sovereign wealth funds, multilaterals, including some of the multilateral entities that are benchmarking themselves against the SDR basket. So during those days, you typically see more than 80% of the foreign holding of China's onshore bonds being these public sector investors. And the rationale is for them to better reflect the asset allocation in their reserve management to better reflect China's economic influence to those countries, as well as their trade relations with China. For example, China's GDP is now around 18% of world GDP. China trade, it's now more than 14% of world trade. But for most of those central banks, their allocation are far lower than these levels. And therefore, for quite a lot of central banks, they actually come from economic and trade reason. There are also a third reason, which is geopolitical considerations. We have seen a number of central banks, including some in the public, notably Russia, has been almost fully sold down their US dollar positions in their official FX reserves due to the US sanctions, and have been fully allocating those positions in euro and CNY. We are aware that more countries are in this camp. So based on our conversation with our own clients, we're talking about a few dozens of global central banks. A number of them do have some considerations from a geopolitical point of view in order to boost their allocation in CNY bonds. But in recent years, especially after the start of index inclusion and with the start of Bond Connect or the more commercial programs, we started to see private sector investors overtaking the public sector investors, and their net purchase of China onshore bonds in the last couple of years has far exceeded of those of the public sector investors. So as of today, we will see half of the foreign holdings being public sector investors and the other half being private sector investors. And these investors are driven by other needs. One of the important needs is diversification. We're here talking about diversification in terms of both performance and liquidity. For performance, it's well known that the China rates cycle and monetary policy cycle do not fully coincide with that of the Fed and the US. And that resulted in a relatively low level of correlation between the performance of CGBs and other markets, and making them an ideal assets to diversify into. And since last March, I think some other colleague here also mentioned about the episode of extreme liquidity stress. If you recall what happened last March, everything lost liquidity, even US Treasury and even gold. But during the exact period, the CGB market, China's domestic fixed income market, were performing as normal as they could be. So for a lot of the foreign investors that have exposure in CGBs, they benefited from an extremely normally functioning market, providing them a very good channel to raise liquidity when liquidity is most scarce elsewhere in the world. So this type of diversification is much needed from the private sector investors' point of view. And lastly, there are always, of course, valuation. So you mentioned about the narrowing interest rate differential. We do forecast a further narrowing of such interest rate differential, but we also believe that China rates will stay above most of their G10 peers for an extended period of time. If you recall and just look at the Fed funds rates, 30 years ago, Fed funds rates were still above 10%. And even 15 years ago, it was still above 5%. And just ahead of COVID, it was at 2.5%. But now if you look ahead, it's almost impossible for Fed funds rate to go back to 2.5%. At least it's not in the current market forecast. So as global debt level increases and as global leverage increase, it's getting harder and harder for most of the markets to raise rates again, including the Fed and including most of the G7 countries. So China is holding a much more conservative monetary policy approach, and it's the only major economy that still have a normal monetary policy. So from that perspective, we believe such a monetary and economic policy will be supporting China's economic growth to stay at a reasonable level in the medium to long term and support a relatively higher rate for the CGBs compared with its peers. Thank you.
Thank you, Becky. Chen, let me turn to you. The Chinese authorities have signaled their intention to simplify overseas investors' investment to CIBN. So could you please explain the progress made so far and what is the direction of travel?
With years of development and the great effort paid by the regulators, the simplicity and efficiency for global investors to access CIBN has been greatly improved. Currently, nearly all overseas investors can access this market easily without quota and fund transfer restriction, and can choose access channels freely, including CIBN Direct, Bond Connect, and QV. A variety of trading instruments are also offered for investors to leverage different trading strategies and risk hedging. Besides, trading mechanism has also been improved with more convenience. In particular, since last year, we have seen a series of measures put out by regulators. For example, allowing RFQ under CIBN Direct, which enables investors to send trades directly through electronic trading platforms like Bloomberg and TradeBank. And this will further increase the trading efficiency of investors. And also extending trading hours to 8 p.m. Beijing time, and the settlement circle from T+3 to T+N also offers more flexibility for investors from different time zones. All these measures aimed at a more efficient and effective trading environment for overseas investors. Actually, ICBC has been working actively to keep our clients updated and get familiar with new functions promptly. And we have helped our clients to complete the first batch of trades successfully. In the future, I think we will keep on leveraging our resources to provide our clients with the most up-to-date services. Thank you. Back to you.
Thank you, Chen. So Henry, what are investors' feedback to these developments and from your relationship with clients? What do you think is most desired change to improve the experience of global investors and to further bolster foreign investment?
Okay, if you are investors exposed to this market for the first time, yes, it could be a little bit confusing for these different access channels. For example, like Bond Connect, CIBN Direct, and QV, right? The problem with the different channel is the application process is not the same for the different historical reason, I think. And for example, if you for the CIBN market, it would take you sometimes maybe around 6 months to locate a custodian banks onshore and get all the documents sorted out. And all these channels are not interlinked and also fungible. I mean, maybe except for the QV and LQV. So if I buy and sell a bond in Bond Connect, I cannot use the other channel to settle. So it would take a lot of explanation to the first-time investors, given different channels have slightly different characteristics. So the consolidation is definitely a good approach, and it would definitely benefit everyone. And I believe it will be integrated over time, but it will also be quite challenging because of the fundamental differences, such as the Bond Connect. If you look at it, I mean, the cash and the settlement accounts are maintained in Hong Kong or offshore CMU system, while the CIBM it's rely on onshore custodian bank settle against the CCDC or SHCH. So, and not to mention the Bond Connect and the CIBMs are monitored by the SAFE and PBOC, while the QFI it's more on the exchange. So, in order to consolidate these two markets and also those three channels, there will be some legals and technical issue that need to sort out, and it will take some time to resolve it. And I just want to point out, other than the access channels, from our experience with the investors, the most urgent need from offshore investors, it's the convenient way to hedge their exposure. That currently the CNY market is a long only market, right? And the bond futures and some of the others products like repos are still not fully open to offshore investor yet. So this would be a meaningful progress if we can do it. And also on the liquidity side, the spread for the CNY on the run and off the run can be pretty wide in the rates areas. And as for the credits, and the many names, they don't have international ratings. Over 40% are rated AAA with the local agencies. And it's really hard for the first time, or the new joiners to distinguish among these bonds. And the local agencies are not broadly accepted by the offshore. So other than the channels consolidation, I think the use of the hedging tools and the rating system to match with the foreign standards, and of course the efficiencies of the platforms, also critical to the foreign investors in order to have them participate in this market. Thank you.
Thank you, Harry. That's helpful to know. So Becky, turn to you again. Currently, the foreign investment in Chinese bond market concentrates around the CGBs and the policy bank bonds. Why is the uptake in credit bonds slow, and what will boost investors' confidence in those?
Sure. So let me give you the numbers first. So if we look at the distribution of foreign holding in China onshore bonds, we have slightly more than half of those are now in CGBs alone, so China government bonds, and another nearly 30% in policy financial bonds, which are issued by the 3 policy banks in China. And it's followed by a type of instrument called NCDs, negotiable certificate of deposit, that accounts for about 7%. So all these to add together, it's already more than 90%. And the remaining portion, it's the so-called traditional credit bonds, including both corporate credit and financial credit bonds. So you can clearly see a preference, and the preference has always been this way. So despite the many years of opening up, the foreign uptake in onshore credit bonds has been staying relatively low. So in terms of the reason, we feel there are 2 reasons. One is more a fundamental reason about the nature of this market. The domestic credit market, despite its size, it's already the 2nd largest credit market in the world, but remains relatively underdeveloped in other features. For example, the secondary liquidity for most of the credit bonds are usually not very good, because the onshore investors are very used to a buy and hold behavior due to the dominance of the banking sector. And second is that in terms of corporate governance, in terms of the bond covenants, creditor protection, etc., there are still a bit more work to do, especially when people are looking into names that with potential or real default risks. So these are the more fundamental reasons for the slow uptick. And there are also technical reasons. I will highlight 2 important technical reasons. The first one is in recent years, the U.S., due to U.S.-China relations, quite a number of top-tier Chinese SOEs are being included in the U.S. entity list. This is making it very difficult for some of the international investors to be holding these bonds, and making it hard for some of the banks to be making market for these bonds. So this is technical number 1. Technical reason number 2 is the availability of a very matured and seasoned offshore credit market for Chinese names. So the offshore Chinese US dollar denominated bond market has grown in material size, and foreign investors can easily access these bonds without any additional setup. So anyone that have Euroclear, Clearstream accounts can directly invest in this offshore Chinese credit, and there are available bonds in dollar, in Hong Kong dollar, and in CNH in the dim sum bond market. And in many of the cases, these bonds would have stricter bond covenants, and slightly better transparency and better secondary liquidity. So compare with the domestic credit bond market, the advantage doesn't appear to be very material compared with this market, and these are the reason for the slow uptick. So from our perspective, the onshore market is not a market we should ignore. It's simply too big to be ignored. We do see there are pockets of opportunities there. So as foreign investors, we would recommend you looking into the following types of onshore credit bonds or non-rates bonds. The first one is a negotiable certificate of deposit. Those are simply like CDs issued by Chinese banks, including state-owned banks. So many of these, nearly all of the the top 5 banks in China are rated single A by international credit rating agencies, and for the shareholding banks are rated BBB by international credit rating agencies. So these bonds are fairly liquid and short dated. So if you would like to get short-term exposure to the China market, you can look at NCDs. And second is the government-supported entity bonds, and these would be the bonds issued by 2 issuers. One is the Railway Corporation, the other is Central Huijin. They enjoy stronger government support, and these bonds can be sold to even retail investors, and therefore their credit risks are considered to be lower. And the third and the fourth types would be the ones that our colleagues had discussed earlier, including both Panda Bond and ABS. Especially for ABS, you would have a lot of the, for example, auto ABS or other type of ABS that are rated even at AAA by international credit rating agencies, and they offer slightly higher yield than other comparable bonds of similar tenor. And in many occasions, their over collateralization extent is even exceeding the international peers. So despite the current situation, we do see pockets of interest, and we do recommend our international investors, after you invest in CGBs, you can consider looking into the other bonds for yield pickup, because as a foreign investor, you do have a tax advantage that it's all of these bonds are tax exempted to you, but not to the Chinese investors.
Thank you, Becky. I'm conscious about the time, but I do want to cover a lot of things. So maybe we run quickly about the rest of the questions. So Henry, from your engagement with international investors, do they take ESG into account when investing in the Chinese domestic bond market?
Yes, ESG is definitely a world trend now and a must for a lot of foreign investors, especially from Europe. And the China's engagement with ESG is becoming more important to foreign investors who want to build their exposures to China's large and fast growing economy, especially when it gains more weighting in the global benchmark index. And the investor, they also want to do it in a manner in line with their commitments to the sustainable investings. So the China also have its own frameworks and priority. I think President Xi Jinping said that countries plan to have the carbon emissions peak before 2030 and achieve the carbon neutrality before the 2060. So China is actually pushing for carbon neutrality, whereas in Europe, the focus may be on the governance, on the social aspect, like the board independence. So when we talk about the China onshore ESG, the main problem is there's only very few issuers got certified with the global standard. So most of the green bonds is only mentioned in the use of the proceeds, but nevertheless, it's still relatively new market for onshore. And anyhow, this is a clear directions and a requirement to develop. So I think the regulators will try to step up and to set the standard in lines with the global, not just in the future. I think they're already doing it now in order to attract more offshore participants to get involved. And recently, you can see that in a couple months ago, the CSRC already refines the ESG disclosure rules for the listed companies. So all the listed companies now required to disclose their annual reports, any penalties relating to the environmental issues receiving during the reporting period. And the key polluting entities are under more stringent disclosure obligation to disclose the additional environmental information, including the pollution's discharge and the status of the pollution control facilities. And also the disclosure on any action to reduce the carbon emissions is now stated as encouraged due to the general promotion of the low carbon transmission of China. And lastly, as for the corporate governance disclosure, I mean, there's a long way to go, but then the new rules also make a number of improvements to existing disclosure requirements, such as on the disclosure on the members of the board special committees and the meeting details measured to guarantee the independencies of the company from the controlling shareholders and the actual controlling person with any potential conflict of interest. So as you can see, I mean, with the support of the regulators, I mean, the ESG developments, it's clearly going to the right directions in China. So that's my 2 cents. Thank you.
Thank you, Henry. So Chen, what are your expectations to develop further to see more liquidity in the market?
Firstly, on the response side, we have already seen substantial advance of secondary market liquidity of CGB and policy bank bonds. For example, the issuance mechanism has been optimized. Since 2019, Ministry of Finance has increased the number of CGB reopening for different tenor CGBs. The frequency of each bond's issuance has been increased to 2 to 5 times annually, and the balance of each bond has been increased to 250 to 300 billion yuan, much larger as compared to 100 billion yuan in the past. And there are also supportive measures for market makers. In 2017 and 2019, Ministry of Finance and China Development Bank both launched the flexible purchase and sale mechanism. This supplementary measure allowed market maker to purchase or sell specific CGB or CDB with 2 issuers frequently, which is also supported for better market liquidity. With all these measures, we expect to see better liquidity in the future. Secondly, we also hope to see more potential in the domestic credit bond markets. With domestic issues keep expanding funding resources, primary markets issuance volume has been increasing accordingly. Regulatory policy-wise, PBOC has allowed international rating agencies' involvement in CIBM and enhanced the credit rating industry regulation, and keeps improving investor protection and risk control mechanism. We believe with such efforts, market transparency will thus be enhanced and in turn lift investors' confidence. As such, we expect that more investors can tap into the credit bond markets. Finally, we look forward to a more robust market infrastructure with continuous opening up of CIBM. We hope that legal formats and documents, as well as treaty and settlement rules of CIBM will be more internationalized. And we believe the infrastructure connectivity between CIBM and other major markets will be further deepened. As the markets keep developing in various aspects, we expect to welcome more overseas investors, which will in turn boost the local market liquidity as well. Thank you.
Thank you, Chen. So I need to wrap up. Sorry, we are running over time, but it's a very heated discussion. I think investors will pay a lot of attention to the Chinese onshore market. I want to thank you again for all the panelists and in fact, all the speakers to this event, and also NAFMII to co-host such an event with us. I think it's very useful to provide such a guidance to the international investors how to access the Chinese onshore market, both from issuer and also the investor perspective. And particularly, I want to thank you all the members within our working group with NAFMII to do the handbook and also the Panda Bond case studies. And thank you very much for your contribution. I want to wrap up our event. And before we go, I appreciate you can give us your feedback, and that will help us how to improve our events going forward. And thank you again for your participation. This is close to the event. Thank you for joining our event. Have a lovely weekend.